Let's talk about tech stocks. Maybe we'll get onto Bitcoin as well. But Nasdaq's bouncing today, but down sharply year to date. To what extent do you think that there has been a total shift in the way that big cap tech is valued?
Well, thanks for having me on, and no worries at all, Wilfred. Look, I think it's important to set some context here and what's happened to the broader technology market, particularly over the last 5 years. So over the last 5 years, tech stocks, the Nasdaq is up almost 3x. The S&P is up 2x. So there's been dramatic outperformance. Some of that has been better earnings growth, but most of it has been that tech stocks have become more expensive. So entering this year, the average tech stock is trading at over 30 times forward earnings. The market's at about 21 times forward earnings. And that nearly 50% premium for tech stocks is the highest we've seen since the bubble collapsed in 2004. And so we've had this build against the context of very low interest rates, where the market has done exceptionally well, and expensive stocks have done even better against that backdrop. And so we entered the year at relatively elevated valuation. So, the market, effectively was saying great things are going to continue. And with the worry with interest rates, you're seeing the market sort of say, okay, maybe that premium is too high to pay now. And particularly for, unprofitable or the most expensive tech stocks. And there are 30% of tech stocks today that are still unprofitable. And more than 30% of tech stocks are trading at more than 10 times sales. And so I think that's what the market is telling us. But it's really important to put this context in play of where we started around valuation and had earnings slowed, or often it's just one trigger point, whether it be macroeconomic developments or earnings slowing or rising interest rates. And this year it happens to be rising interest rates, which are really causing people to scrutinize valuations.
At the same time, you're also dealing with these questions, Tony, around some of the tech stocks about just how much business was pulled forward during the pandemic because everything went online and everything went digital, and all these trends that were in place got accelerated. And one of those you were looking at today was Apple. You published a note on this. What did you decide? Did that business get pulled forward, and is there going to be a give back?
Yeah. So, Sarah, what our observation is that prior to last year, if you looked at Apple's operating profit growth in the previous 5 years, it was about 4% a year. Last year, Apple's operating profit grew more than 60%. So it's really, really striking to see this. And we've seen this with some other companies as well, but certainly Apple, because of its large capitalization, is a particular interest. And, Apple benefited from several things. It's a major player in education. It's a major player in consumer. There was a lot of work from home. There was a lot of school from home. And its iPad and Mac businesses exploded. Those were businesses that weren't really growing. And iPhone had a great year. And pricing was very, very firm across the entire market. So revenue was great. Margins were great. And I think that's a question for many investors, that in some cases for consumer-oriented companies or companies where there were shortages and pricing was very firm, whether that level of success can be repeated going forward. And so that, I think, is also an important overarching question in the marketplace.
Tony Sacconaghi, thanks so much for joining us. We appreciate it.
Thanks for having me. Have a great weekend.